welcome to the chapter-wise content for the ACCA FM syllabus. As you can see in front of you, I have the presentation open for the chapter 1. The name of the chapter is Financial Management Function. Here, like I was telling you, we are going to have an introduction. It's going to be the stepping stone. What all do we need to know so that we can get started with the subject of what financial management is? So we will learn firstly the definition of financial management. So here is a quick overview of what all we are going to be learning here. Firstly, we'll talk about the role of financial management. What's the nature and purpose of it? What relationship does it have with financial and management accounting? Then we are going to talk about what are strategies, what are objectives. We will also learn to evaluate about the entities whose main objective is not to make profit, what you call as NPOs, not-for-profit organizations, or charitable organizations. Then we are also going to learn about the agency theory, who are the different stakeholders in the business, who are directors and shareholders, what kind of relationship do they have, what about the managerial reward schemes, and what about corporate governance. So all of these are the topics that we are going to cover as a part of this chapter. So we are going to first get started with financial management. What the definition of financial management is. We are learning the entire paper of financial management. So it's important that we start off by getting to know what financial management really is. What does it mean? So you have the definition in front of you. Let's break this definition down word by word, piece by piece, and understand the meaning of this definition. So I will break it down into this. First word is efficient. Then you talk about acquisition and use of what? Short term and long term, something which is a financial resource. So these are the breakdowns of these definitions. Let's talk about the terminologies one by one. So first word says efficient. Okay, we'll first understand what the definition entirely is, and then we will say that all of this we will be doing efficiently. This is the meaning of FM. So the second terminology that you see reads acquisition and use. What do you mean by acquisition? Acquisition means acquiring, taking, and then you use. So whenever a business is formed, the business is not born with funds, right? So it needs money. So first step is to acquire the money to start up the business. And then once you have the money, how do you use that money is what we do in financial management. So acquisition and use of what? Short term and long term. So here we are not only dealing with the long term things, everything under money, financial resources is going to come into the ambit of financial management. So short term as well as long term, both is going to be dealt with in financial management. So we are talking about acquisition and use of what? Of financial resources. So financial resources could be about raising money, could be about buying assets, could be about providing dividends. So all of this, the management of money basically is financial management, if I put it in a layman's language. But here, to technically break down the definition, we are going to acquire the funds, we are going to use the funds in an efficient manner. That means money should be placed in the most productive manner. Wherever you are getting more and more returns, money should be invested over there so that you're able to bring more and more wealth to your shareholders. Ultimate objective of the FM function, financial management function, is the wealth maximization of shareholders. What do you mean by wealth maximization? All that the shareholders have invested, their capital should grow. That means the share price of the company should grow, and also the companies keep giving dividends to the shareholders. So shareholders should keep receiving dividends, and the share price should also keep rising. So this is all what we do as a part of financial management. Now head towards the three decisions which are under the ambit of FM. So if you have studied these decisions before, then it's good. If not, we are going to break it down right from the beginning. So there are three primary decisions that we talk about in FM. First, I will start off with explaining you the financing decision. So financing decision, let's talk about a business which is not yet started. We are thinking to start a business. So the first thing is you need money to start any business. So financing decisions is all about how much money is going to come from where, how much money are we taking from equity, how much money are we taking a loan off. So all of this becomes a part of financing decisions. Where is the money going to come from, how much money is going to come from what source, is what we decide under financing decisions. Then once you have the money, that money is not going to sit idle and give you profits. You'll have to invest that money somewhere to make returns out of it. So you are going to make an investment decision. So investment decisions are all about deciding where to make your investments. Deciding where to invest your money becomes a part of your investment decisions. And the third one being dividend decisions. So once you have invested in an asset and you have generated profit, now how much of the profit retains with the company? How much profit is the company sharing with the shareholders? Firstly, do we share any profit or not? So the first question is, do we give any dividend or not? Secondly, if we are giving the dividend, how much dividend should we be paying is going to be a part of your dividend decision. So these are the three primary decisions which we do as a part of financial management. Now let's head further. Here we talk about corporate strategy and objectives. Now the word strategy in the general form means, if let's suppose you want to achieve something, you're all studying the ACCA FM paper. So if you are studying the ACCA FM paper, you are doing it with an objective. You want to pass the paper with good marks. This is what your objective, this is what your aim over here is. So here what you're going to do is to achieve this end result. This is not going to magically happen. How is it going to happen? You're going to have to come up with a plan that, okay, I'm going to cover the concepts, then I'm going to practice questions, and then I'm going to attempt the mocks which I will get evaluated from my faculty, and this is how I prepare to pass for my exam. So the course of action, the plan that you have created to achieve your objective is what you call as strategy. So this is how you have strategized that this is the way that I plan to pass my paper. So this is exactly the definition that you see here. Strategy is the course of action to achieve an objective. So if you want to achieve anything, what steps you take towards it, what planning you do, what course of action you set for yourself is a part of the strategy. Then let's talk about objectives. So you people have the objective of passing the FM exam with good marks. Corporate objectives will be the objectives which any company has. Whenever the word corporate comes with any other word, it ultimately means that thing from the perspective of the corporate or the company. So whatever objectives the company as a whole has, what do they want to achieve is part of corporate objectives. Then how does a business develop their objectives? So the first step is they identify the relevant stakeholders. Now who is a stakeholder? Stakeholder is any person who gets affected by the activities of the business. So you have stakeholders. We will talk about who are the stakeholders a little bit later also in this chapter only, where we talk about who all people get affected by the company. So it's the shareholders, it's the managers, it's the employees, it's the customers, it's the suppliers, and it's the general society. How is the general society impacted? Let's suppose we have our factory someplace in a remote area, and the factory dumps all of the pollution in the water body which is near us. So that water body gets polluted because of the waste that we throw into it. And now because we throw that waste and the water has become polluted, the people who are living nearby, their health is getting affected as a result of it. So our company is affecting them, hence they become a stakeholder. So stakeholder is any person who gets affected by the company's activities. So firstly, whenever the company is wanting to develop the objectives of the organization or the company, the first step will be to identify the relevant stakeholders. Now, whenever you talk about the corporate sector means the type of organizations which want to make profits, which want to make money. So if you want to make money, your primary stakeholders are going to be the shareholders. Who are shareholders in any company? These are essentially the owners of the company. They people have invested capital in that company for that company to be formed and then run its business. So they are the real owners, and they appoint somebody else, which is known as the managers or the directors, who then run the company on their behalf. So the first principal stakeholder for any corporate sector is going to be the shareholders. So because shareholders are the ones which we want to satisfy, the ultimate objective, as I was just telling you earlier also, the ultimate objective of FM is to maximize shareholder wealth. All the efforts that we are doing as a part of financial management, everything that we are learning is towards the final contribution to help the shareholders wealth get maximized. So whatever money they are making, be it in the form of dividends, be it in the form of increase in the share price, it should be to increase the wealth of the shareholders. This is the principal, primary, ultimate objective of financial management. Now let's head further. So if you see that maximizing the shareholder wealth is the primary objective, then obviously it is going to come with a few consequences. So what are the consequences? Firstly, it is going to be easier to raise new finance and grow in the future. So if historically till now you have been giving good returns to the shareholders, they will not mind putting in some more investment so that that money can also grow. So if a company is actually maximizing the wealth for their shareholders, they will find it very easy to raise new finance and ultimately grow in the future. Then the next point that you see is means must be providing customers with what they require. So earlier, when industrialization had just started, it was so that consumers were many but producers were less. There were lesser variety of goods that were produced, lesser number of suppliers were there. So what happened, that customers really did not have any choice. Now today, in today's time, you have so many choices around you. Now whenever you do not have any choice, ultimately what is available to you in the market, whatever price it is available to you, you are supposed to buy it at that if you want it. But today's times have changed. Why? Because you have so many options available to you. And when you have so many options available to you, you become a person of your own choice. So whatever you like, whatever custom made for you is the thing, is what you're going to purchase. So this is how, if any organization wants to grow, if they want to maximize the wealth of the shareholders, the means must be to provide the customers with what they require. So you will have to modify yourself, taking into consideration what the customers want from you, and you will have to provide them exactly that. So this is the second point explained. The third bullet that you see is, if you don't provide adequate returns, you may become a target for hostile takeover. Now, what does this point means? So this means that if the shareholders are not satisfied with the returns that they are getting, then the company starts to lose its value. What happens when the company starts to lose its value? The people who are having their eyes on your business, who never wanted you to succeed, or maybe who are looking to acquire you, who want to buy the company, so they are going to take your company over in a hostile manner. Hostile means nobody gets to know about this. It happens all of a sudden. So very recent example where this happened is the acquisition of Twitter by Elon Musk. So all of a sudden he bought the shares of the company because the earlier shareholders were not happy. So now what he did was he bought all of the shares from those shareholders who were the earlier shareholders of Twitter, and he took over the company in a hostile manner. He took over the company, bought all of the shares, and named himself as the CEO of Twitter, and he also renamed Twitter as X. So if you do not work on maximizing the wealth of the shareholders, this is what happens. You become a target for hostile takeovers. Then the next bullet point that you see is legal duty to run the company on the behalf of the stakeholders. Now, if the directors, so basically like we were talking about, shareholders are the real owners of the company, and the directors are just somebody who shareholders have appointed on their behalf to run the company for them. Now, the directors have a legal responsibility, they have a legal duty to act in the best interests of the shareholders. So, if shareholder wealth maximization is being followed, then they will also be following their legal duty, which is to actually ensure that the shareholder wealth gets maximized. Then you have some other consequences also. If you focus too much on shareholder wealth maximization, some things can go wrong too. What all can go wrong? Firstly, it ignores market imperfections, for example, public interest. So let's suppose the company that we are operating is maybe a hospital. So hospital people come to hospitals whenever they fall sick, whenever they require some medical treatment. So if our entire motive is to make profits and to ensure that we follow that objective, to achieve that objective, we keep our prices so high that it is not possible for any normal person to get the treatment done at our hospital. This is what private hospitals are doing these days. Public hospitals run by the government are separate, but the ones which are private hospitals which are operating for the profit motive, they keep their prices so high that it's practically unaffordable for the common man of India. So it ignores public interest if you are focusing too much on maximization of shareholder wealth. Second point, which is a drawback, is it ignores social needs. So again, health, education, these are all basic amenities for life. If somebody is suffering from a medical ailment, they require medical treatment. If somebody is not really in a good position financially, but they still want their children to be educated, there should be a facility to get your children educated. So if you're focusing too much on the shareholder wealth maximization, you are compromising on public interest, you are compromising on the social needs. Then the third bullet that you see is it ignores the interests of other stakeholders, for example, customers and employees. So if we want to maximize our profits as a company, what are we going to do? We are going to charge increased prices. Whatever price we charge from the customers, the selling prices, we are going to hike them so that we make more and more money. So are we compromising the interest of another stakeholder? Yes, the customers want to pay a price which is genuine for the services that they are getting, product or service that they are getting. But if you are charging too much just to prioritize the maximization of shareholder wealth, then you are ignoring your other stakeholders, which is customers. Another point is with respect to employees. So to maximize the profits for the company, for the shareholders, what you might try to do is you might try to reduce the salaries of employees. Do not give them maybe the salary hikes that they deserve. So again, you are indeed maximizing the profits, but what happens to the employees? They are going to suffer because they are not getting the fair remuneration as they should be getting. So if you are focusing too much on shareholder wealth maximization, this is another problem which arises. And then the last point tells you for unlisted companies, even shareholders might not require maximum returns. So sometimes shareholders have just put in their money because they want to serve some sort of a purpose. So they want that the things should keep running, things should keep happening, but we do not mind if we don't receive too much of income. So if still the business is focusing too much on maximization of shareholder wealth to increase the wealth of the shareholders, what will happen is these people, whatever these shareholders have started this company for, that might suffer because they're focused too much on the wealth maximization aspect. So this is all about the corporate strategy and objectives. Now we are going to move to the next aspect, which is financial objectives. So financial objectives means it is again related to money aspect. Money aspect from the POV of whom? The point of view of shareholders. So a shareholder gets returns from the company. How does a shareholder get return from the company? Firstly, they get dividends. Secondly, if the price that they purchase the shares for gets increased, then they make a capital gain. So the shareholder wealth is measured by a ratio known as TSR, which stands for total shareholder returns, the formula you can see in front of you over here. You are supposed to take firstly the dividends. This is the first type of return that shareholders make. Secondly, they make a capital gain. So this part, year-end share price minus share price at the start of the year, this is the second part of the return that they make, which is the capital gain. You will understand this better with the help of the numerical example that we have over here. And in the denominator, you're supposed to compare it with your initial investment, that was the price at the start of the year. You multiply this by 100 so that you get your ultimate answer in a percentage format. So an investor purchased 100 shares in ABC at the beginning of 20x0 at the market price of 10. So you have purchased how many? 100 shares at a price of 10 per share. So this is the share price at the beginning of the year. During the year, investor has received a dividend of 1.2. So this is the first type of income, the dividend income per share. At the end of 20x0, shares has an ex-dividend market value of 12.9. Now, this ex-dividend and cumulative dividend, these are a few terminologies which we are going to get familiar with further. For now, you can even ignore this term. The shares, you can say, have now a market value of 12.9. So this means investor has gotten returns in the form of two ways. Firstly, the investor has gotten a dividend. Dividend is 1.2. Then the second kind of return is he bought the share at 10 and now the same share is 12.9. So 12.9 is what it is now. He bought it at 10. That means he has made a gain of 2.9. So this is the two kinds of income that the shareholder has received from the company in this year. So 1.2 plus 12.9 minus 10. So this gives you 2.9. 2.9 plus 1.2 divided by $10 because that's the share price at the start of the year, and that is going to give you your answer as 41%. So that means the shareholder has gotten a total return of 41% by investing in this share. Now you have also been told about what are the two components. Firstly, the shareholder has made capital gain. The thing that he purchased for 10 has now went up to 2.9. So 2.9 divided by 10 gives you 29% of return. And then he has gotten a dividend. How do you calculate the dividend return? 1.2 is the amount of dividend that you have gotten. Again, divide that by your initial investment of $10. So it's a 12% return. So you can even add both of these figures, 29% plus 12%. This is also going to lead you to the same answer of 41%. So these are the two components that we have in the total shareholder return. Now let's read further about what is another way to talk about to measure shareholder return is EPS. EPS stands for earnings per share. So this means how much ever profit is left for the shareholders, you divide that by the number of shares and that gives you the earnings per share. How much the shareholder has generated per share is what you measure in EPS. So I will explain the formula that is given to you. It says PAT, profit after tax, minus preference dividend. So why are we doing that? Let's start it from the very scratch. How does your statement of profit or loss start? It starts from the top item, which is the sales item. So you start off with sales. From sales, you subtract your variable cost, which gives you your contribution. Now, once you have achieved your contribution, you next subtract your fixed cost, which leaves you to your PBIT, which is profit before interest and tax. Next, the business subtracts the interest payment that they are supposed to make, and then they are left with PBT, profit before tax. Then the business subtracts their tax payment, and ultimately what is left is PAT. So this is the amount of money which is left after which is left in the business after tax has been paid. Now there are two kinds of shareholders. Firstly, you have ordinary shareholders and then you have preference shareholders. So these two are a part of equity technically, but what happens with preference shareholders is it has mixed components, equity as well as debt. So what makes it different from normal equity? You pay a fixed percentage of interest. So if it says 9%, you're going to pay 9% interest to the preference shareholders and nothing above that. So once PAT has been paid, PAT is left, you then subtract the preference dividend. Preference dividend is subtracted, and then what is left? This remaining amount is what actually gets remained for the equity or the ordinary shareholders. So because in EPS we are measuring how much return they have made, in the numerator you take all the number which is left after everyone has been paid off. So the creditor hierarchy is also something like this. The company will always first pay off their external debt, any bank loan, any debentures. Then the company is going to repay any of the preference share capital. And then at the very last comes the turn of the equity shareholders. So they are in the last of the hierarchy. So when the company makes any profits, all of the expenses are subtracted first relating to all of these stakeholders. And then what is left actually gets remained for the ordinary shareholders. So this is why we have this as a part of our numerator. And in the denominator, you're supposed to take the number of shares. So if let's suppose the profit after tax minus preference dividend is $100 million and the company has 50 million shares in issue, that will give me an EPS of $2. So that means my shareholder, if any shareholder has one share, they have made an earning of $2 on that one share. So this is the ratio of EPS. This is another ratio which is used to measure the shareholder return. Let's head forward now to a real world example where we are going to talk about a not-for-profit company. So whenever you talk about a not-for-profit company, things get very different as compared to what you will usually have for a profit-making entity. How is it different? Because the whole objective is different. A profit-making company exists because they want to make money. Whereas a not-for-profit organization will have a different objective. They are not here to make money, they want to serve some purpose. So here we are given with an example of a university. So what all are the stakeholders of a university? The students who study at the university, they get affected by whatever the university does. Then the government who provides the funding to the university for its running, and then the employers. Who are the employers? The employers are the people who hire the students after they have completed their graduation or post-graduation. So here, every stakeholder is going to have a different objective, and that is why it is going to be even difficult for us to measure if the not-for-profit entity has been able to achieve its objective or not. So firstly, students, what will the students want? They will want the best of faculty. They will want that one teacher should be teaching lesser number of students so that more attention can be paid to each student. They will want infrastructure to be very nice, very good libraries, very good maybe sports facilities. So this is all that the students are going to want. What happens? What will the government want? Government is spending money at the university. So the government will want to minimize the cost while at the same time achieving the objective. Minimize costs as much as possible. So if the students want the best of faculty, the faculty is going to be paid nicely also, which will involve costs. So it conflicts with the objective of the government. Then the students are going to want infrastructure, government will want to minimize the cost. Again, infrastructure comes with a lot of spending. So again, conflicting objectives. Then let's talk about employers. What are the employers going to want? They are going to want that the students who study at the university, they are taught at the best standards so that they are ready to take up the job as soon as they graduate from the college. So they should be job ready. They should have all of the skills that are needed to go ahead in a job. So this is how, because different stakeholders will have different objectives, it becomes very difficult to measure whether the not-for-profit organization is achieving its objective or not. So here you can read about it. Management is accountable to multiple stakeholders, students, government, and potential employers. However, requirements of stakeholders may conflict. Students may desire small class sizes, again, so that more attention can be given to each of them. Large library, courses that meets their interests. Government may wish to minimize the cost per student. Potential employers may want graduates with relevant skills for the industry, engineering graduates as opposed to anthropology graduates. So designing a performance measurement system to deal with such different and multiple objectives is very difficult. So as a result, what solution do we have is we use the value for money model, VFM in short. Here we are going to learn 3 E's. Those 3 E's we are going to learn in the next video.